Thank you very much, Mr. Chairman, Mr. Ryan, members of the committee. It's a real pleasure to be with you this morning. My name is Bill Beach, and I'm the director of the Center for Data Analysis at the Heritage Foundation. We're at an odd moment in the evolution of these economic challenges. There is great hope, but little evidence that the credit market fixes will work. There is increasing concern, but again, little evidence to date that the financial crisis will push the general economy into a severe recession. My own sense is that we have passed into a recession that could become significantly worse and long-lived if Congress and other governments make wrong or ineffective policy moves. Recessions that start in credit markets last longer than those that stem from shocks to aggregate demand or supply. This one looks like it could be with us for a long while unless we do highly effective things to reduce its impact. The question now is, what should Congress do? Congress obviously should do nothing to harm the economy. I always say that in my testimony. It should let the Federal Reserve lead the effort to stabilize economic activity. It should keep its focus on crafting long-term pro-growth economic policy. Most importantly, Congress should make no change to basic policies that would signal increases in risk, either through raising taxes or through increasing burdensome regulations. It also should be extremely wary of any legislation that could in any way be interpreted as America withdrawing from international product or capital markets. Congress can ill afford to repeat the awesome errors of its predecessor in the early days of the Great Depression and retreat from the world economic stage. I recommend that Congress address economic policies in three interrelated areas, all of which affect near and long-term economic performance. And I'll speak about the first two of these three: tax policy, energy policy, and long-term spending. There are areas of economic policy where congressional action can be timely and targeted, though it may not intend to be short-range in focus at all. Those areas involve the reduction of investment risk. What can increase risk? Many factors, of course, but public policy commonly looms large. Tax increases, especially if they land on capital, increase the cost of capital and lower investment returns. When investors are uncertain about whether taxes will go up or stay the same, they still can act as though taxes have risen if they judge the risk of an increase to be nearly equal to an actual increase. And rising uncertainty can have the effect of driving down investments in riskier undertakings. So here's what I recommend on the tax side, and I know that this is something that can be timely and targeted, but I don't know temporary. Make the tax reductions of 2001 and 3 permanent. Thus, among the first things that Congress can do to address the current slowdown is to pronounce definitively on the tax increases scheduled for 2009 and 2011. There are projects, new businesses, and expansions of existing businesses that would be undertaken today if Congress signaled that taxes would be lower in 3 years. Since nearly all major capital undertakings last beyond this 3-year period, it is likely that making all or most of the Bush tax reductions permanent would stimulate economic activity today as well as in 2011. Accelerated depreciation. In addition, we know from past experience that accelerating the tax depreciation of capital equipment and buildings for a one-year expensing of business purchases that otherwise would be depreciated over a longer period of time is a good way to stimulate the economy. This was certainly the record in the last slump, and Democrats and Republicans have commonly supported this approach. Look at taxes on capital gains and dividends. We also have recent experience with reducing the tax rate on long-term capital gains and dividend income. If Congress were to reduce these tax rates by 50% or more in the next 2 years, the cost of capital to businesses would fall and investment stability would be enhanced. Indeed, if Congress were to approve a temporary zero capital gains tax rate on new stock issues, troubled banks could raise more of the capital they desperately need without having to go every day to the Treasury Department. Lower the corporate profits tax. In one area of fundamental public policy, there's now universal agreement. Our federal business taxes are far too high. The tax rate on corporate profits is the second highest in the world. Why is it not the firm policy of this committee and this government in this country to make certain that the corporate profits tax is always below the average corporate income tax of other industrialized countries? Such a policy would enhance our competitive standing worldwide and significantly reduce the incentive for U.S. firms to relocate to lower tax countries. If Congress were to make the tax reductions of 01 and 03 permanent and lower the corporate profits tax from 35 to 25%, I estimate the following economic effects would ensue. This is done from a model of the U.S. economy, which is in widespread use throughout the government and the private sector. More jobs. By making the 01 and 03 tax reductions permanent and reducing the corporate profits tax by 1,000 basis points, an annual average of 2.1 million more jobs would be created. Indeed, over the 10-year period for which these forecasts apply, 3.4 million more jobs would be created above baseline, current law baseline, in 2018. These tax moves would dramatically increase the level of national output. The growth rate of the economy would increase by a full half percentage point in 2011 and 2012, when taxes will otherwise increase under current law. The annualized growth rate jumps by 0.3%. On average, gross domestic product averages $284 billion more over the 10-year forecast window. These tax changes dramatically improve household income, partly because the economy is so much better and partly because the average tax burden falls. The average household would have an additional $5,138 more to spend or save after paying taxes. By 2018, that amount rises to $9,700 additional after-tax dollars. And let me just say something quickly about energy policy, because it's also related to getting the economy moving. Rapidly increasing prices for gasoline and petroleum-based energy generally slowed the economy and made the economy more vulnerable to the economic setbacks that we're having today. If Congress acts to expand energy supplies, forward-looking prices will fall and economic activity will shed off the drag that stems from that sector. Let me illustrate in closing. Economists working with me in my Center for Data Analysis at Heritage estimated the economic effects of a $2 increase in retail unleaded gasoline. We have just experienced such an increase over the past 14 months. We found that total employment falls by 586,000 jobs. After-tax personal income falls by $532 billion. Personal consumption expenditures fall by $400 billion, and significant personal savings are spent to pay for the increased cost of gasoline. Those are the damages that were done when the gasoline prices were rising rapidly upward. A resumption of world economic growth might again fuel those increases. So look to energy policy as one handle that you can use in stimulating the economy. Thank you very much.